Welcome to the Nifty Noon podcast. We've got a massive stack of sources today, a full week's worth of insights from our newsletter running from December 15th through the 19th, 2025. When we look back at this week, I don't think it'll be seen as just a pivot point. It feels like this was the week the financial systems officially, finished their merger.
That's the perfect way to put it. For you, the mission statement for this deep dive is really clear. We need to show how the boundaries between traditional finance TradFi and the crypto world, they didn't just blur this week. They completely collapsed. We witnessed a full institutional commitment across the entire stack.
Yeah, and it wasn't just one big story. It felt like a sustained 5-day onslaught of integration news.
Exactly. And we can basically synthesize this entire week into three major connected threads. First, we saw regulatory integration. Crypto firms officially receiving federal bank charters.
Which means they are now federally supervised, really cemented into the U.S. financial system.
Right. Second, institutional adoption just hit a whole new gear. You have the biggest names in finance, JPMorgan, Visa, launching major on-chain products. They're validating blockchain as, a core piece of settlement infrastructure.
And then the third thread, platform expansion. This is where the crypto natives like Coinbase looked at their success and basically said, we're not just a crypto exchange anymore, we're an everything exchange.
And started moving aggressively into traditional markets like stock trading. It was a full stack revolution, all in one work week.
Okay, let's unpack this and start right at the foundation with the most foundational news from the beginning of the week, Monday, December 15th. This is when the idea of crypto banks officially arrived on the federal level.
That Monday was completely dominated by the Office of the Comptroller of the Currency, the OCC. They granted conditional approval for national trust bank charters to 5 major crypto firms. We're talking Ripple, Circle, BitGo, Fidelity Digital Assets, and Paxos.
Our newsletter called this a massive boon for the industry. But hold on, these are limited purpose charters, right? They don't allow the firms to accept cash deposits or issue loans like a typical bank. So are they really banks?
That's a really crucial distinction for you to understand. The real strategic insight here isn't about what they can't do. It's about what they can do and, critically, the door that it opens. Because they're federally supervised, they can formally offer custody, stablecoin issuance, and tokenization services to institutional investors who are, legally required to use regulated counterparties.
So you're saying this is the key. This is what unlocks institutional capital pension funds, insurance companies, all of them, that require federally regulated custody for digital assets.
Precisely. It signals the official end of that perceived war on crypto and formalizes a stable, supervised path forward. Think of it as just infrastructure compliance. For example, Circle got conditional approval for their first national digital currency bank for USDC. Ripple is doing the same for its RLUSD stablecoin.
And it happened fast.
Oh, immediately. BitGo's CEO confirmed they quickly satisfied the conditions, and just like that, they became a fully licensed national trust bank.
And that regulatory clarity is clearly flowing downstream. One of the interesting nuggets from that Monday showed stablecoins already moving into consumer commerce.
Absolutely. YouTube announced it would let U.S. creators get payouts in PayPal's PYUSD stablecoin.
So they're integrating crypto payment options directly into the platform.
Yeah, and it's this kind of quiet, powerful adoption. You're getting paid in the digital dollar without ever needing to, navigate some complex exchange.
Before we move on, we have to touch on the market curiosity section from Monday. It highlighted this fascinating detail about the iShares Bitcoin ETF, IBT. It's one of those facts that just tells a whole story about institutional behavior.
This is a wild piece of data. So since the IBT ETF launched, if you had only owned it after hours, so buying at the close and selling at the next open, it was up a staggering 222%.
How?
But if you only owned it intraday buying at the open, selling at the close, it was down 40.5%.
That's a huge delta. It tells you exactly when the biggest players, the traditional funds, are executing their trades.
It's the ghost of TradFi operating hours, haunting the crypto market. It shows where the leverage and the volume really lie.
And just for balance, in the native crypto world, Monday saw Meta Legends, #651teen, top the NFT charts at 22.90 ETH.
closely followed by a Fidenza by Tyler Hobbs. So the digital collectible market is clearly still generating massive value alongside this institutional push.
Okay, so if Monday formalized the regulations, Tuesday, December 16th, showed us the major money followed suit. Let's talk about JPMorgan.
Right, here's where it gets really interesting. JPMorgan, which let's remember is the largest bank by market cap and whose CEO was a huge Bitcoin skeptic. They launched their My On-Chain Net Yield Fund, MONY, directly on the Ethereum blockchain.
And they seeded it with $100 million of the bank's own capital. But wait, is this just sophisticated PR? I mean, are they truly embracing blockchain, or is this $100 million fund just a drop in the bucket to, I don't know, placate regulators and capture that RWA narrative?
That's a fair challenge.
Well,
While $100 million is, pretty small for JP Morgan, the choice of infrastructure is the key. They are using Ethereum, a public, permissionless blockchain, to host a tokenized money market fund. This perfectly cements the real-world asset, or RWA, trend.
okay, hold on. For those catching up, when we talk about RWA, what exactly does that mean JP Morgan is tokenizing here? Is it bonds, money markets?
In this specific case, it's short-term debt securities. So think of institutional money markets. The tokenization means that qualified investors can earn yield on these assets on-chain, and they can subscribe and redeem using Circle's USDC stablecoin.
So it's not the size of the fund, it's the fact that a bank of that size is using a public blockchain for its core function. It's building that fiat-to-chain bridge.
Exactly. And JP Morgan wasn't alone in this institutional charge on Tuesday. Visa launched a stablecoins advisory practice to help other institutions build out their own stablecoin strategies.
They're positioning themselves as the experts for all the other giants who are now scrambling to catch up.
And speaking of giants, MicroStrategy's parent company, Strategy, just kept on accumulating. Another 10,645 BTC for nearly $1 billion. That commitment, it just remains unwavering.
It shows the two forces, institutional adoption and corporate treasury strategies, are really moving in parallel.
And we also had PayPal's PYUSD officially become the largest dollar stablecoin issued under federal regulatory oversight, following its conversion to an OCC trust charter, another ripple effect from Monday.
And Tuesday's top NFT sale was CryptoPunks, #5143, selling for 44.99 ETH. It seems like the high-end digital art market is just staying robust through all of this.
Okay, that brings us to Wednesday, December 17th. Visa didn't just advise on stablecoins, they took institutional adoption from theory to practice.
They absolutely did. Visa announced they were bringing their stablecoin settlement pilot to the U.S., allowing partners to settle transactions using USDC. And they made a definitive technological choice: the Solana blockchain for the U.S. rollout.
That is massive validation for Solana. Why Solana specifically? It was chosen pretty much entirely for its throughput, its ability to handle thousands of transactions per second.
Right.
Visa's goal is to bypass the incredibly slow traditional banking rails, which can take days, and just leverage that 2047 instant settlement capability of crypto.
And this program is already processing an annualized run rate over $3.5 billion globally.
It's a huge number. This shows the global shift is driven purely by technical efficiency.
So the regulators are catching up to the technology speed. We saw the FDIC approve new procedures that day, right?
Precisely. The FDIC approved a proposal establishing procedures for FDIC-supervised institutions that want to issue payment stablecoins via subsidiaries.
So the government is actively laying the groundwork for how these new digital dollars will be managed inside the traditional banking structure.
Yep, making the whole system more robust and compliant. And this institutional trend, it isn't just a U.S. or dollar-pegged thing.
Right, it's global.
No, we saw Japan's SBI Holdings partner with Startail to develop a regulated yen-pegged stablecoin. It shows that regulated digital currency infrastructure is becoming a global standard.
Meanwhile, a huge NFT sale, wrapped Etherrock #38, went for 90.00 ETH. It just reminds us of the immense liquidity still circulating in the original crypto ecosystems.
Yeah, exactly.
That takes us to Thursday, December 18th. We've covered TradFi, we've covered regulation, but Thursday was the day the retail side of crypto, the exchanges, decided they couldn't be left behind. Coinbase threw down a massive challenge.
Thursday was Coinbase's big strategic pivot. They unveiled a major update aimed at transforming it into the everything exchange. And they're directly competing with platforms like Robinhood for the next generation of retail finance.
What defined this everything exchange ambition? It sounds like they are trying to become a financial super app.
They absolutely are. And they did it by hacking TradFi and native crypto at the same time. First, they added traditional stock trading equities for U.S. users, 245 with zero fees. This is a direct shot across Robinhood's bow. Second, they're diving into the hot new market of prediction markets. They've got a partnership with Kalshi, enabling betting on real-world events.
That prediction market move is particularly savvy, just given the competitive context.
It really is. We noted in our newsletter that Robinhood is also accelerating its prediction markets hub, and they confirmed it's their fastest-growing revenue line. So this is a crucial battleground.
So it's merging finance with data-driven speculation.
And third, Coinbase integrated other crypto ecosystems, specifically Solana DX trading via Jupiter. So now users can access Solana DeFi and meme coins without ever leaving the Coinbase app.
So they're saying, whether you want to buy Apple stock, bet on the next election, or trade the latest Solana meme coin, you only need one application. It's a total convergence onto the user interface.
And it creates a fascinating juxtaposition. While Coinbase is focusing on this hyper-speed integration, we also saw Tether introduce a new password manager, PeerPass. And their stance is all about local, decentralized security. The tagline is, no servers to hack, no cloud to leak.
It's a quiet reminder that not everyone trusts the big centralized platform model that Coinbase is building.
That contrast really captures the schizophrenia of this market, doesn't it?
It does. While JPMorgan and Coinbase are settling millions in trading equities, we still have these high volatility native crypto assets doing their own thing.
Exactly. Thursday's NFT daily losers list was brutal. Mad Lads and Bitcoin Puppets saw huge drops, down 8.35% and nearly 10% respectively.
A reminder that even as TradFi integrates, the native crypto markets retain their characteristic breathtaking volatility.
Yeah, and CryptoPunk #3150 also sold for a solid 26.90 ETH that day. So liquidity remains, but the speed of movement is just dizzying.
Which brings us to Friday, December 19th. This brought the institutional circle to a close with what felt like the most definitive, confidence-inspiring step yet toward crypto legitimacy and safety.
Friday delivered the ultimate institutional mic drop. SoFi launched SoFi USD. This is the first fully reserved stablecoin issued by a U.S. national bank, SoFi Bank N.A., on a public permissionless blockchain, Ethereum.
Okay, so why is this distinction being issued by a national bank so important compared to what Circle or PayPal were doing earlier in the week?
This is a massive step in institutional legitimization because of the reserve structure. This is the distinction you absolutely need to grasp. Unlike most other stablecoins, which hold reserves cash, T-bills in various commercial bank accounts, SoFi USD is 1.1 reserved, with cash held directly at the Federal Reserve.
So that Federal Reserve backing, that's the key difference, right? It means they bypass commercial banking risks entirely.
Exactly. It moves the perceived risk for the user from, is this private company or its bank safe, to, is the Federal Reserve safe, which is just a monumental psychological and regulatory shift.
It offers what you'd call bank-grade safety.
Right, essentially eliminating liquidity and credit risk for the stablecoin holder. And SoFi is positioning itself as core infrastructure. They're white-labeling this service for other institutions.
Aiming to power instant 24/7 settlement for the whole banking industry.
Precisely. They're leveraging their regulatory status to become the silent pipes of the next financial system. And we immediately saw market demand for this kind of thing. Circle, the longtime stablecoin giant, partnered with Intuit to integrate stablecoin capabilities across TurboTax, QuickBooks, and Credit Karma.
That partnership shows the mainstream consumer finance world refunds, remittances, small business payments. It is ready for this digital dollar integration. It confirms this week wasn't just theoretical, it was immediately actionable for millions of users.
And if we connect this back to the bigger picture, this week just demonstrated a full-stack institutional commitment to blockchain technology. We started with federal charters for crypto firms on Monday, progressed through major banks using high-speed blockchain rails midweek, and we culminated in a U.S. national bank issuing its own digital dollar reserved at the Fed on Friday.
The separation between TradFi and digital assets is effectively over.
It is. The infrastructure is integrated and it's operational. And even in the NFT space, Friday closed with a massive sale, Azuki Elementals #1058 for 190 ETH. It shows immense confidence at the high end, even as Bitcoin Puppet's volatility remained high, dropping almost 11%.
The pace of these changes is just breathtaking. And for you, this rapid integration raises a really critical question you should be mulling over. Now that we have bank-issued stablecoins like SoFi USD reserved directly at the Fed, alongside federally regulated crypto-issued stablecoins like USDC and PYUSD, what are the critical differences? Differences in trust, adoption pathways, and inherent risk that you should be considering as you navigate these new forms of digital money. Which one ultimately gains wider adoption? We hope this deep dive was helpful. Thank you for listening to our newsletter. You can follow Nifty Noon on X and subscribe on Substack for all of our daily insights.